recent months, a growing number of market commentators have warned that the global financial system is on the brink of collapse and that silver is positioned to become the primary beneficiary of this instability. While such warnings sound compelling and often emotionally persuasive, they deserve careful scrutiny before investors restructure portfolios around them. The claim that the financial system is approaching a breaking point typically rests on several recurring arguments: expanding sovereign debt, fragile banking structures, currency debasement through monetary policy, and disruptions to global supply chains. These themes appear persuasive on the surface. However, when examined through the lens of modern macroeconomic behavior and historical crisis cycles, the conclusion that collapse is imminent becomes far less certain. Yes, global debt levels are high. That observation is accurate, but high debt alone has never been a reliable predictor of systemic breakdown. What matters far more is debt service capacity relative to productivity growth, fiscal flexibility, and institutional credibility. Major economies such as the United States continue to finance deficits at historically manageable levels relative to GDP growth expectations and global demand for reserve assets. Debt expansion may signal structural imbalance over the long term, but it does not automatically translate into near-term instability. Similarly, the argument that artificially suppressed interest rates have created unsustainable conditions oversimplifies the role of central banking in modern economic stabilization. Interest rate management today functions less as a distortion mechanism and more as a counter-cyclical policy tool designed to smooth volatility across business cycles. While prolonged accommodation can introduce asset pricing distortions, it has also extended recovery periods and reduced the severity of recessions compared with earlier monetary regimes. Concerns about banking fragility are also frequently overstated. Modern regulatory frameworks implemented after the global financial crisis significantly increased capital adequacy requirements, stress testing standards, and liquidity buffers across major banking institutions. Unlike the pre-2008 environment, today's system operates under layered supervision designed specifically to prevent cascading insolvency events. While vulnerabilities always exist, describing the banking sector as structurally unstable ignores measurable improvements in resilience over the past decade. Another commonly repeated assertion is that fiat currencies are rapidly losing credibility and approaching a tipping point. Yet, global reserve currency dynamics remain remarkably stable. Despite periodic inflationary pressures and expansionary fiscal policies, demand for U.S. Treasury securities continues to demonstrate strong international confidence in dollar-denominated assets. Currency systems rarely collapse suddenly without preceding institutional fragmentation, and current indicators do not support that scenario. Supply chain fragility is also frequently cited as evidence of systemic weakness. However, what recent disruptions have actually demonstrated is adaptability rather than collapse. Corporations have diversified sourcing strategies, increased inventory flexibility, and accelerated regional manufacturing adjustments. These responses indicate structural evolution rather than systemic failure. Perhaps the most overlooked factor in collapse narratives is market psychology itself. Extended periods of stability often produce cycles of pessimistic forecasting that exaggerate downside scenarios. Investors tend to interpret volatility as structural breakdown rather than normal cyclical adjustment. As a result, narratives predicting imminent crisis gain traction even when macroeconomic indicators remain within historical ranges. This matters because investment positioning based on collapse assumptions introduces its own risks. Markets rarely reward strategies built entirely around worst-case scenarios. Instead, long-term portfolio resilience typically emerges from diversification across asset classes, balanced exposure to both growth and defensive instruments, and disciplined responses to policy signals rather than emotional reactions to alarm-driven forecasts. None of this suggests that the global financial system is immune to stress. Structural vulnerabilities clearly exist. However, framing the current environment as uniquely fragile compared with previous decades risks overstating the case and encouraging investors to make decisions based on fear rather than probability. Before concluding that precious metals, particularly silver, are poised to benefit from imminent systemic failure, it is essential to examine whether the underlying premise of that failure is itself supported by evidence or amplified by narrative momentum. As highlighted in the original warning framework, the argument rests heavily on debt expansion, banking leverage, currency policy concerns, and supply chain dependence. The critical question investors must ask is not whether risks exist, they always do, but whether those risks justify repositioning portfolios around expectations of near-term financial collapse. In disciplined financial analysis, that distinction makes all the difference. One of the central claims supporting the argument for an imminent silver price surge is that silver is dramatically undervalued relative to gold, industrial demand, and historical precedent. This narrative has circulated for decades and continues to reappear whenever macroeconomic uncertainty rises. Yet when examined through a disciplined valuation framework, the conclusion that silver is currently mispriced by an extraordinary margin becomes far less definitive than it initially appears. The most frequently cited evidence of silver's supposed undervaluation is the historical gold-to-silver ratio. Commentators often highlight that silver once traded near a long-term ratio of approximately 15 ounces to 1 ounce of gold, and argue that today's elevated ratio signals a structural pricing anomaly that must eventually correct. However, this comparison assumes that historical ratios represent a stable equilibrium rather than a reflection of changing monetary regimes. In reality, the gold-to-silver ratio has never been fixed by market fundamentals alone. For centuries, it was shaped by government minting policies, bimetallic standards, and monetary legislation, rather than purely by supply and demand. Once global currencies transitioned away from metallic backing, the ratio naturally began reflecting differences in investment demand, industrial usage patterns, and market liquidity. Treating a centuries-old ratio as a modern valuation anchor risks oversimplifying a far more complex pricing mechanism. Another pillar supporting the undervaluation narrative is silver's dual identity as both a precious metal and an industrial commodity. While it is true that silver plays an important role in electronics, renewable energy infrastructure, and medical applications, industrial usage alone does not automatically translate into higher prices. Commodity markets respond not only to demand growth, but also to substitution potential, technological efficiency improvements, and recycling capacity. Over time, manufacturers consistently adapt to rising input costs by reducing material intensity or shifting toward alternatives. This dynamic limits the ability of industrial demand alone to sustain long-term price acceleration. Unlike purely monetary assets, industrial commodities operate within competitive production ecosystems that moderate extreme valuation outcomes. Supply constraint arguments are also commonly presented as evidence that silver is positioned for dramatic appreciation. It is certainly accurate that mining production faces geological limitations and rising extraction costs in some regions. However, global commodity pricing rarely depends exclusively on primary mine output. Secondary supply from recycling, byproduct extraction from base metal operations, and technological improvements in recovery efficiency all contribute to the broader availability of silver in circulation. Moreover, commodity markets tend to respond dynamically to sustained price increases. Higher prices incentivize exploration, technological innovation, and expanded production capacity. As a result, supply constraints that appear severe under current price conditions often become less restrictive over time. assuming that present-day mining challenges will automatically translate into persistent scarcity, overlooks the adaptive nature of resource markets. Investor perception is another factor frequently cited as evidence that silver is under-owned and therefore poised for rapid repricing. While it is true that gold receives greater institutional attention as a reserve asset, this difference reflects structural characteristics rather than market neglect. Gold's role as a central bank reserve instrument naturally supports deeper liquidity and broader adoption within sovereign portfolios. Silver, by contrast, occupies a hybrid position between industrial commodity and investment metal, which shapes its ownership profile differently. This distinction does not necessarily imply undervaluation. Instead, it reflects the different functions each metal performs within the global financial architecture. Assets that serve different roles should not be expected to trade according to identical valuation frameworks. Monetary policy is often presented as another reason silver should already be trading significantly higher. The argument suggests that expansionary central bank balance sheets and prolonged currency accommodation should have pushed silver upward alongside other hard assets. However, asset price responses to monetary conditions are rarely uniform across categories. Precious metals, equities, real estate, and commodities each react differently depending on investor positioning, inflation expectations, and global liquidity flows. In recent years, much of the liquidity created through accommodative policy has flowed into technology equities, infrastructure investment, and alternative asset classes, rather than into industrial metals. This pattern reflects investor preferences rather than pricing distortion. Markets allocate capital according to perceived opportunity, not historical precedent. Another frequently repeated claim is that silver's historical volatility should be interpreted as evidence of suppressed value waiting to be released. Yet volatility alone does not signal mispricing. In many cases, it reflects the relatively smaller size of the silver market compared with gold and other major asset classes. Smaller markets naturally experience sharper price movements when capital flows shift direction. Interpreting volatility as latent upside potential risks confusing market structure with valuation opportunity. Price variability can just as easily reflect cyclical sensitivity as it can signal future appreciation. Timing arguments also deserve careful evaluation. Forecasts suggesting that silver is entering a uniquely favorable moment often rely heavily on macroeconomic uncertainty as justification. While uncertainty can increase interest in defensive assets, it does not automatically produce sustained commodity rallies. In many historical cases, precious metals strengthened only after clear inflationary confirmation, rather than in anticipation of it. Investors, therefore, face a critical distinction between narrative-driven positioning and evidence-driven allocation. The belief that silver is dramatically undervalued relative to gold, industrial demand, and monetary expansion may contain elements of truth, but it does not by itself guarantee an imminent repricing cycle. As outlined in the original framework supporting the bullish silver thesis, arguments centered on historical ratios, industrial usage growth, constrained supply, and investor neglect are frequently presented as signals of extraordinary opportunity. The more important question for disciplined investors is not whether silver has potential upside. It clearly does. But whether current market conditions justify treating that potential as inevitable. Understanding that distinction helps separate strategic allocation from narrative momentum and allows investors to approach precious metal exposure with greater clarity and balance. A major component of the bullish silver narrative is the claim that market conditions are aligning for a near-term price breakout driven by supply shortages, monetary expansion, institutional accumulation, and historical precedent. While each of these arguments contains elements of plausibility, the conclusion that a dramatic upward move is imminent deserves closer examination. The most frequently cited catalyst behind the projected surge is the assumption that supply constraints are tightening rapidly enough to trigger a structural imbalance. It is certainly true that some large silver mines face declining ore grades and rising extraction costs. However, commodity pricing rarely responds to supply pressures in isolation. What ultimately determines sustained price acceleration is the interaction between production capacity, substitution flexibility, investment demand cycles, and global growth expectations. In the case of silver, a significant portion of production comes not from primary silver mines, but as a byproduct of copper, zinc, and lead extraction. This means silver supply is indirectly influenced by broader industrial activity rather than silver prices alone. When base metal production expands during economic growth cycles, silver availability typically increases as well. As a result, the relationship between silver scarcity and price appreciation is less direct than often assumed. Industrial demand is another pillar supporting predictions of an imminent rally. Silver's role in electronics, renewable energy infrastructure, and advanced manufacturing technologies is well established. Yet industrial demand growth does not automatically translate into rapid price escalation. Manufacturers continually improve efficiency, reduce material intensity, and develop alternative technologies when input costs rise. These adaptive mechanisms have historically moderated the long-term price impact of commodity-driven demand expansion. Another argument frequently presented is that global monetary policy has created conditions favorable for precious metal appreciation. Expansionary central bank balance sheets and long periods of low interest rates are often interpreted as signals that tangible assets must eventually outperform financial assets. However, the relationship between monetary expansion and commodity prices is neither immediate nor linear. Over the past decade, liquidity injections have primarily supported equity valuations, infrastructure investment, and real estate markets rather than industrial metals. This reflects the reality that capital flows towards sectors offering the strongest expected returns, not necessarily toward traditional inflation hedges. Assuming that monetary accommodation will automatically translate into a silver rally overlooks the complexity of modern asset allocation behavior. Institutional positioning is sometimes cited as early evidence that a breakout is already underway. Reports of increased ETF holdings or hedge fund interest are often interpreted as confirmation that large investors are quietly accumulating silver ahead of a major move. While shifts in institutional exposure can influence short-term price dynamics, they do not always signal the beginning of sustained multi-year trends. Large investors frequently adjust commodity exposure as part of broader portfolio rebalancing strategies, rather than as expressions of directional conviction. Temporary increases in positioning can therefore reflect tactical adjustments rather than structural accumulation. Historical comparisons are also commonly used to support expectations of a rapid silver surge. Previous cycles in which silver significantly outperformed gold during periods of financial stress are often cited as evidence that a similar pattern is about to repeat. However, historical parallels should be interpreted carefully. Each macroeconomic cycle unfolds within its own policy environment, technological landscape, and geopolitical structure. The drivers behind past silver rallies, including currency regimes, inflation expectations, and investment market accessibility, differ substantially from today's conditions. Relying too heavily on historical analogies risks overlooking the structural differences that shape current market behavior. Timing remains one of the most challenging aspects of any commodity price forecast. Forecasts suggesting that investors must act immediately to capture the majority of silver's upside often rely on the assumption that markets move abruptly once awareness spreads. While sudden price acceleration can occur, markets typically incorporate information gradually rather than instantaneously. This gradual adjustment process means that opportunities rarely disappear overnight. Investors who approach allocation decisions with discipline rather than urgency are often better positioned than those responding to warnings framed around narrow timing windows. Another factor frequently overlooked in surge narratives is the role of inflation expectations themselves. Precious metals historically perform best when inflation becomes persistent and structurally embedded rather than when it is merely anticipated. If inflation expectations remain anchored by credible monetary policy frameworks, commodity price appreciation may proceed more slowly than many forecasts suggest. Similarly, geopolitical instability is often presented as a catalyst for rapid silver appreciation. While geopolitical tensions can temporarily increase demand for defensive assets, their long-term influence on commodity pricing depends heavily on whether they disrupt trade flows, production capacity, or financial system stability. Not all geopolitical risk translates into sustained commodity rallies. As emphasized in the original argument supporting the expectation of a near-term silver breakout, supply limitations, industrial demand expansion, monetary policy accommodation, institutional interest, and historical precedent are frequently presented as converging signals of an imminent surge. However, disciplined market analysis requires distinguishing between supportive conditions and decisive catalysts. Supportive conditions may create the potential for appreciation, but they do not guarantee the timing, magnitude, or durability of price movements. Investors who recognize this distinction are better equipped to evaluate silver not as a certainty-driven opportunity, but as one component within a broader strategic allocation framework. In times of economic uncertainty, it is entirely natural for investors to look for assets that can preserve purchasing power and reduce exposure to financial instability. Precious metals, particularly gold and silver, have historically played an important role in this defensive positioning. However, the argument that they represent the primary or even the most urgent solution for protecting wealth in today's environment deserves closer examination. One of the most frequently repeated claims in defensive investment narratives is that fiat currencies are undergoing structural erosion and therefore cannot be relied upon as stores of value. While it is true that inflation reduces purchasing power over time, modern currency systems operate within complex policy frameworks designed specifically to manage these pressures. Inflation targeting, interest rate adjustments, and coordinated fiscal responses are not signs of currency collapse. Instead, they represent mechanisms intended to maintain long-term monetary stability. Reserve currencies in particular benefit from institutional trust, deep capital markets, and global demand for liquidity. These characteristics make sudden currency failure extremely unlikely outside of scenarios involving severe political disruption or structural fragmentation. Treating gradual currency depreciation as equivalent to systemic monetary breakdown risks, exaggerating both the scale and the speed of potential risks. Another commonly emphasized recommendation is the accumulation of physical precious metals as a primary defense against banking instability and market volatility. While holding tangible assets can contribute to portfolio resilience, relying too heavily on any single asset class, no matter how historically respected, introduces its own concentration risk. Gold and silver function most effectively as components within diversified strategies rather than as standalone solutions. Their performance tends to improve during specific macroeconomic conditions such as persistent inflation, declining real interest rates, or confidence shocks within financial systems. Outside of those environments, their returns can remain stable but comparatively moderate relative to growth-oriented assets. Diversification, therefore, remains one of the most powerful tools available to investors seeking protection in uncertain markets. Real assets such as infrastructure, energy exposure, and selective commodity sectors can provide inflation resilience alongside precious metals. Equities in defensive industries, including utilities, healthcare, and essential consumer sectors, have historically demonstrated the capacity to maintain stability during periods of economic stress. Real estate can also serve as a partial hedge against currency depreciation when supported by favorable demographic trends and regional economic strength. These alternative defensive assets illustrate that wealth protection does not depend on a single category of holdings, but rather on the interaction between multiple resilient components. Another important factor often overlooked in precious metal-focused strategies is liquidity management. During periods of financial stress, investors frequently require access to capital quickly. While physical metals can preserve long-term value, they are not always the most efficient instruments for immediate financial flexibility. Maintaining a balanced structure that includes both liquid instruments and long-duration protective assets allows investors to respond more effectively to changing market conditions. Flexibility, rather than rigidity, often determines the success of defensive strategies during volatile periods. Strategic accumulation is another concept frequently emphasized in discussions about precious metals. The idea that investors should gradually build positions over time rather than attempting to time market bottoms is sound advice. However, this principle applies equally across diversified portfolios rather than exclusively within the precious metals segment. Disciplined allocation strategies benefit from consistency, risk awareness, and alignment with long-term financial objectives. Investors who interpret accumulation as a justification for concentrated exposure may unintentionally increase portfolio vulnerability rather than reduce it. Education and macroeconomic awareness also play essential roles in effective wealth preservation. Monitoring central bank policy signals, fiscal spending trends, and global trade developments provides investors with context for evaluating potential risks before they materialize. Knowledge does not eliminate uncertainty, but it significantly improves the ability to respond to changing conditions with clarity rather than urgency. Psychological discipline may be the most underestimated component of wealth protection strategies. Market narratives that emphasize urgency often encourage investors to act quickly rather than strategically. Yet long-term portfolio resilience is rarely achieved through reactive positioning. Successful defensive investing depends less on predicting dramatic turning points and more on maintaining structured exposure to assets capable of performing across multiple economic scenarios. This approach reduces reliance on any single forecast about inflation, currency weakness, or commodity cycles. As outlined in the original argument supporting accelerated precious metal accumulation as a necessary response to currency debasement, banking instability, and geopolitical uncertainty, physical assets, particularly gold and silver, are presented as central tools for protecting purchasing power in a fragile financial environment. However, the broader lesson for investors is not that precious metals should be avoided. Rather, it is that they should be understood within the wider architecture of modern portfolio construction. Wealth preservation rarely depends on identifying one perfect asset. It depends on building a structure capable of adapting to multiple possible futures. In today's environment, protecting wealth is not about reacting to warnings of imminent collapse. It is about preparing intelligently for uncertainty while maintaining exposure to opportunity. Investors who approach this challenge with balance, discipline, and perspective are far more likely to preserve and grow purchasing power than those who rely on single asset solutions driven primarily by urgency narratives.